Let me start with the market outlook. Some investors are talking about a potential Santa rally toward the end of this year. Do you expect that to happen? And what could be the key drivers behind it?
So I do think we could have a year-end rally. I don't think necessarily because of the calendar that just we tend to have these Santa rallies. I would argue the biggest driver would be the ongoing AI narrative and the ongoing optimism around investment in artificial intelligence and what it may deliver, what that investment may deliver in terms of increased productivity and increased profitability. But I wouldn't chalk it up to seasonal factors. An old Wall Street saying is appropriate here: the trend is your friend. And the trend has been upward, that we're in a rally. It seems to be gathering momentum, at least when you think about the AI stocks that are at the heart of it, and the way that any AI announcement is greeted very, very bullishly, that stocks are going up 5-6% if you sign some sort of a deal with OpenAI or with NVIDIA for chips. So I think, yes, I do expect we'll keep rallying into year end, but it's not seasonal. It's about principally this AI optimism.
And what's your target for the year-end S&P?
We're around 6,700 now, 7,000. Nothing tremendously exciting there, but I would base case expect 4 or 5%. If people get really excited and the narrative picks up and momentum even accelerates, maybe we're up 10%. So maybe we're up in the 7,500 range. But I would expect slightly up from here.
People think the Fed will be our friend. The Fed is expected to cut interest rate next week. And do you think another rate cut in December is likely as well? And when do you think we are hearing something concrete about the QT end?
It certainly looks like the Fed's going to cut next week. Our best guess is that they will cut 25 basis points next week and then by 25 basis points again in December. But I don't think that December has been decided. They keep saying they're data dependent, and I believe them. And remember, we haven't really had much data since the government shutdown. So I do think they're going to cut next week. But we may, between next week's meeting and the December meeting, have a lot of data that come out, right, as we get the retroactive data, that may tell us, gee, the economy's a good bit stronger than we thought. Maybe the labor market bounces back, maybe it bounced back in September and October, and they'll also have the November data before the December meeting. And that may make them say, wait a minute, we did have to cut in October because of softness in the labor market, but now that softness in the labor market isn't there anymore. Or conversely, like, wow, it's not just the labor market is growing slowly, that non-farm payroll is growing slowly, but non-farm payroll is contracted in September, October, and November, and therefore we got to cut at least 50 basis points in December. So I do think what happens in December is very much contingent on the data flow between now and then, and that data flow is going to be a little more rapid than normal if we ever do reopen the government, because we're going to be getting several releases that we haven't gotten already. As far as QT, I don't really have a timetable as to when we're going to get anything concrete, but the way we're thinking about it at BCA is QT will end when the Fed becomes nervous that reserve balances have gotten too low. And it does sound like Chair Powell did devote some of his most recent appearance to quantitative tightening, and he seemed to suggest that an end could be coming pretty soon, because this year or early next year, as the reserve balances that they target, that they've cited in the past, the range that they want to see, we're pretty much there. And I don't think the Fed is eager to see reserve balances decline below the range where they want them to be.
A lot of economists say trend of economy is going upward, but the labor market trend is going down. It's kind of a K-shaped economy, something like that. Yep. In this case, if that is true, how the Fed will react about it?
It's hard. It makes their job difficult because they've got a dual mandate. And by statute, that dual mandate is the Fed is supposed to promote price stability, so keep inflation from being too high, and full employment, to keep the unemployment rate as low as they possibly can without encouraging inflation. All else equal, I think right now they'll be more attuned to the full employment element of its mandate, and I think that's what the Fed has somewhat signaled by making it clear we're going to cut rates in October. We clearly think there's a need to cut rates, even though inflation is still well above its stated 2% target. So for now, the Fed is willing to emphasize the full employment over price stability, and we'll see what comes next. If you would see inflation after having fallen to get to this 3%, then kind of just sitting there. If inflation were to tick up to 3.5, 4, then the Fed is going to have to put out the inflation fire, and it'll deal with full employment a little further down the road. So it's not easy to be the Fed right now.
Who do you think is most likely to become the next Fed chair? And some people believe that the new Fed leadership could bring back the policies like QE, which could push the long-term rate lower. And do you see that happening?
I don't think the Fed wants to go back to zero interest rate policy, and I don't think it wants to go back to expanding the balance sheet if it can avoid it. Now, I think it has more of an aversion to zero interest rate policy than it does to buying bonds again. But I still think it's a fairly high hurdle to clear to be buying bonds. The Fed doesn't exactly know what happens when it normalizes its holdings, right? And they're still way above where we were at the end of 2007 before QE initially began. So I think that something of a last resort would be the QE, and that first the Fed will use its typical means, which is adjusting the Fed funds rate, adjusting short rates. And eventually you lower the Fed funds rate enough, presumably the long end of the curve, the 10-year, is also going to follow directionally. Now, it may not be basis point for basis point, but again, so the curve may steepen, in which rates come in, but they come in more at the low end. They fall more in the low end than they do at the long end. So if my hand is the yield curve, right, and the low end comes in more, they can both come in, but it actually steepens, that the spread between the 10-year yield and the Fed funds rate widens. I don't think they'll be too concerned about some steepening. Typically, that is what we get when the Fed cuts rates. But it is possible that the White House, having its eye on mortgage rates, which are generally set based on the 10-year yield, that the White House would insist that, gee, why don't you do something to take care of the long end? I understand you set short rates, but can you do something to influence long rates lower? Surely the Fed will see that sort of pressure from this administration, and it'll be quite public, right? It'll come in a Truth Social post or 10 with some name calling to boot. And then that makes the identity of the chair, I think, more important, because it might tell us something about how susceptible the Fed would be to that sort of outside pressure.
The 10-year Treasury yield has dropped below 4%. And where do you see it heading by year end?
I'll say 3.75% to 4%. I think slightly lower from here, that it continues to ease. It's not at all impossible that we go to 4 to 4.25%, but I'll vote for 3.25% to 4%, because I think the economy is softer than the consensus perceives, and that therefore the labor market is going to continue to show signs of weakness. It's going to weaken even further from what it's shown so far, and that will give us a backdrop in which markets expect we definitely will get that second 25 basis point cut this year. And if the labor market shows enough signs of weakness, if its deterioration speeds up in a material way, then maybe 50 is on the table for the December meeting. And that would imply, even though I think the curve would steepen, even though I don't think you'd see the 10-year yield fall 25 basis points if the Fed cuts 25 basis points, or 50 if it cuts 50, that would certainly give it scope. If you tell me we're going to have 25 next week and then 50 base points of cuts in December, it's a certainty. The Fed funds rate is going to, the 10-year yield is going to be below 4% by year end. Again, my base case is 25 and 25, and I think that will support 3.75% to 4%.
Tariff has been a key driver of recent price pressure. Do you think the tariff-related inflation is temporary, and are we at the point where inflation is no longer a major concern for the market?
I think it remains a concern for the market. I think it's more of a concern than it should be, again, because I think the probability of a recession is much greater than markets seem to. I think that a recession will cure any inflation pressures. Right? So I think there's a much greater probability that we will have a recession that completely stamps out inflation pressures than markets currently perceive. As for the tariffs and whether they produce one-off inflation or an extended period of higher inflation than we would otherwise have, I'm very much in Governor Waller's camp that I think tariffs are temporary. And the way I like to think about it is when you have tariffs, you have a one-off increase in prices if to the extent that businesses are able to pass on, right, the price to the end user. You'll get a one-off increase in prices. That means the CPI index rises, right? And if my hand is CPI, the slope at which my hand's going upward, that's the inflation rate, okay? So let's imagine I'm at 2% here. You have tariff shock. That gives you a new price level up here, okay, because we had this increase. But I would argue, since I believe that tariffs hurt growth, that must mean I believe they impair aggregate demand. So demand in the economy, I think with tariffs, is less than it would be without them. All else equal, that means the price level should rise at a slower rate if you have less demand. So if we start with my left hand here, I had some implied 2% slope, and we now have my right hand to reflect the tariff price increase, I would argue the slope after that increase is going to be flatter than it would have been without it because tariffs hurt growth. And that if there's anything close in the slopes of my hands to what would really happen, that over time, I think they converge. I think the price level gets to where it would have been had we not had the tariffs in the first place. And therefore, I don't think there's any permanent impact on inflation.
In this time will take a year, right?
Maybe. Now that's a good question, right? Is it 1 year? Is it 2 years? So when they merge, don't know. That's a guess. I'll say 1 to 2 years. However, what I am more confident in, you have this slope to begin with. I do believe after you get the tariff, my upper hand slope is flatter. So even if you have this one-off move, and I know we're not at 2% right now, it's fine, we're at 3% right now, you get this one-off move, I think we are no more than 2% going forward. And maybe it's even less than 2%. Now, however much less than 2% determines when these two are going to intersect. But that's the way I see it. It's a one-off move in the price level, but it actually, because it is growth negative, it slows the rate at which the price level rises going forward.
The upcoming US-China summit is getting a lot of attentions. And how do you expect the meeting to play out? And do you think both sides will find some middle ground? Or could China choose to bear economic pains and continue escalating tensions, especially given that the Trump political strength could fade if he loses next year's midterm elections?
I think we'll find a middle ground. And I think the answer is very much in what you're alluding to, that I think we get to the middle ground. I think we get to a settlement, not because China isn't willing to bear economic pain, but because it won't have to. Because the United States threshold for pain, the White House's threshold for pain, is dramatically lower than Beijing's, precisely because of the midterm elections and because all polling data that we have indicates the tariffs are a very unpopular policy. American voters are not out there saying, yes, we want the government to impose tariffs. So this is effectively a losing issue for the Republicans. President Trump is a Republican. The Republicans currently have a majority in both houses of Congress, but it's a very, very narrow majority in the lower house, the House of Representatives. If the administration wants to preserve that narrow majority in the House and somewhat larger majority, but hardly a big one in the Senate, the upper house, it better get tariffs out of the news well before campaigning begins in earnest for that November 2026 election. I think we'll get a middle ground. I think we'll see it by February or March at the latest, because it is in the White House interest to settle before this can impair the Republicans' prospects in the midterm election. So I think China won't have to bear very much pain. As long as China is resolute until then you will have a settlement.
Starting November 5th, the Supreme Court will begin hearings on whether Trump tariff under IPA were illegal. And what kind of a ruling do you expect, and how could that affect the market?
So I must give the disclaimer here, I am not an attorney and never have been, and I'm absolutely not an expert on constitutional law. I understand from some clients who are that the tariffs clearly were illegal. And when I say illegal, all I mean is that the administration exceeded its authority when it applied blanket tariffs against many other trade counterparties in the absence of a true emergency. That IEEPA, one of the E's stands for emergency. Therefore, if this didn't rise to an emergency, and or if you can't apply these to 17 different countries, then the administration lacked the authority to impose the tariffs. And if that view of the statute is correct, then that means the tariffs are null and void. I say that, this illegal answer, with 51% certainty, like as narrow as small a possibility, because this is not what I do. And even among constitutional law experts, it isn't certain. Although I do get the idea from clients that it's 75 or 80% certain. However, we know that politics can intrude on what judges decide, and the Supreme Court basically, its current majority is because of President Trump's first term. Right? These were hand-picked people who, while I'm not at all suggesting they will just do the White House's bidding, they were selected because they have a worldview that aligns with conservative priorities. So, and with those conservative priorities, generally expanding the executive branch's power. So they may take a broader view of what the executive branch is allowed to do and say you can't have them. Ultimately, though, the market impact, so I think these will likely be declared illegal, right, with very, 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 very small conviction. But I think if they are declared illegal, the administration will just cite another authority to reimpose them. And these other authorities do exist. The wrinkle is that they have a time limit on them, 6 or 12 months. And I think there's also a maximum level, right? You can't exceed a certain magnitude. But that maximum magnitude isn't too far from where we are now. So the only question, so you basically have tariffs imposed under IEEPA. Now they move to these other authorities, and they're time limited for 6 or 12 months. But there's nothing in the law that says you can't extend them for another 6, another 12 months. So you could get to the exact same place, simply with the administration having to actually formally reimpose them after the time limit ends. So I think we're just going to have to live with tariffs, and this like 15% baseline rate looks like what we're going to have to live with. It may vary at the margin, limit what the administration can do with China, but that just feeds back into what we talked about before, that I think you get a settlement, and you get a settlement with the U.S. giving in, not China giving in.
Let's move to the AI. We are seeing massive capital spending by companies like Amazon and Microsoft, NVIDIA, and they said demand for cloud and AI capacity still far exceeds supply. How long can this demand boom last? And I saw the day before yesterday, one Wall Street Journal articles saying that Sam Altman drive intense FOMO among the NVIDIA, AMD, and Broadcom, and leading to the huge supply deals. And it seems like everyone is driven by Sam Altman's grand visions. What do you think about it?
I think that FOMO exists, and being driven by Sam Altman's grand visions gets reinforced because whenever a company announces some deal with OpenAI, that OpenAI is going to buy double-digit billion of chips from us, or other equipment, and then we're going to turn around and take an equity interest in OpenAI, that the stock goes up anywhere at least 5% and maybe as much as between 10 and 15%. So yeah, that's real fear of missing out, right? When all you have to do is hold a press conference and your stock goes up 10%, there are going to be lots of publicly traded companies that are lining up to be able to make those announcements. I think the surge in investment in data centers, servers to go in the data centers, GPU, graphics processing units to go into the servers, electricity to power the data centers, I think that all lasts for sure at least another 4 quarters.
Gold prices has been quite volatile lately. What is your outlook for gold and silver and heading into next year?
So yet another thing on which I'm not an expert is precious metals or commodities in general. I'll say higher, but at a slower pace than gold and silver have been appreciating to this point. It has been a really steep rise. And we do believe at BCA, one of the drivers of the pickup in gold prices, one of the drivers in demand for gold, has been central banks around the world diversifying their reserves out of the US dollar. The euro isn't a great substitute for the dollar. The yen is even smaller, and the yuan doesn't really float freely, right? There are capital controls around it. So they're really, and the Canadian dollar too small, the Aussie dollar too small, the New Zealand dollar too small, the Swiss franc too small. So there doesn't appear to be a contender for reserve currency from the US dollar. But if you saw what the United States did to Russia's holdings in the United States once it invaded Ukraine and tried to, and to somewhat effectively, freeze Russia out of the global banking system, and just as the United States froze Iran out of the global banking system and had the ability to seize Iran's reserves held in the States as well, maybe you want to get out of USD, especially if you think you might become an adversary of the United States. Well, where else would you go? If there isn't another currency, you could go into gold. And we think it is very clear since Russia's invasion of Ukraine that this trend has been going, and it's been sizable, of central banks buying more gold, and that correlates quite well with the rise in gold prices that we had seen starting in 2022. Now, the inflection to really, really steep increase in gold prices that we've seen recently, we don't think that has anything to do with central bank reserve buying. Perhaps that is individuals speculating. That's my best guess. We don't think it really reflects deep concern about inflation because you don't see the inflation expectations as implied by the break-even rate between TIPS, Treasury Inflation Protected Securities, and nominal treasuries, and you don't see it with inflation.
It's steady.
Right, exactly. And you don't see it with inflation-linked securities elsewhere in the world. So we don't think this is about broad inflation fears. We think it started with central banks diversifying their reserves away from the dollar. We think that will continue.
5-10 years more?
I'll say 5. Sure, I would say 5. It takes time to move the battleship.
At least foreseeable future, right?
Right, but yes, I think, however, that's a pretty gentle tailwind. That does not support gold doing this. It might, all else equal, support gold rising at a very slight level. And we think that's all that you're going to get from the central banks. It's a tailwind, but not much of one. And that doesn't begin to explain gold really breaking out recently. We think that's more about speculation. Eventually that speculation, that's going to end.
The dollar index dropped about 11% in the first half of this year, but it's recently rebounded by 3 or 4%. And do you think the dollar will stay strong or weaken again?
We unanimously believe at BCA in the long term, so let's say 3 to 5 years, the US dollar is going to weaken, it's going to weaken a lot. On any purchasing power parity measure, the US dollar is considerably overvalued. What complicates that in the near term is that the US dollar for a long time has behaved as a counter-cyclical currency. When you have a recession globally, USD rises, and the only two currencies that are even more defensive than the dollar, the yen and the Swiss franc, also rise. And then when you have broad global expansion, robust expansion, you have those three currencies decline relative to higher beta currencies like the euro, and especially like emerging market currencies that are more exposed to the global business cycle. So if we have a recession in the near term, which I think we can, my best guess is a recession will begin in the United States before March 31st. I also believe that the United States economy is so large that if you have a recession in the United States, you're going to have one globally. So if we are going to have a global recession in the near term, I think you're going to see the dollar appreciate in the near term. But I have that 3 to 5 year view that it declines, and it declines a lot. That's after we get past the recession, then we're back to a global expansion. Then I think you see that overvaluation as implied by purchasing power parity, that begins to narrow until the dollar is more fairly valued on PPP terms. And to get from here down to here, that does imply a sizable decline in the dollar.
Last question. Fed is cutting rate, and you said the AI investment will remain strong, at least 4 quarters. But you think the recession will come anytime in near term? I couldn't understand.
Sure, that sounds a little inconsistent. Yeah. Hopefully this will resolve it. I think the labor market is vastly more important than AI investment. If the labor market is vastly more important than AI investment, even if the AI investment continues at a very robust pace over the next 4 quarters, deterioration in the labor market is going to make consumption growth slow so much that you get to a rate that's consistent with a recession. And in inflation-adjusted terms, that's really anything below 1%. So anything below 1% real consumption growth, that is consistent with a recession. I've seen charts of AI investments' purported contribution to real GDP growth and consumption's contribution to real GDP growth. Originally, for the first half, U.S. consumption grew at 0.9% annualized. That's when we got the first estimate of second quarter GDP at the end of July. When that was revised in August, it only went up to 1%. But then the final revision in September pulled it all the way up to 1.5%. The first two estimates, you had consumption flirting with stall speed, flirting with recession growth at a time when you unquestionably have employment growth flirting with stall speed. Now that consumption did get revised up, so consumption is not flirting with stall speed anymore. But I think the originally reported data are a taste of what's to come if the labor market continues to soften. And it is my base case that the labor market will continue to soften. Now back to that chart where the two were merging, and people were saying, wow, AI CapEx contributed as much to economic growth in the first half as consumption did. That's a really big finding because consumption's 2/3 of the US economy. Well, for one, they're no longer touching because consumption was revised up from that original 0.9 to 1.5, but even attributing 0.9% of growth to AI investment was incorrect. The way people got there is they just looked at the software line item within non-residential investment in GDP. You look at a chart of the last 20 or 30 years, software had already been contributing on average 40 or 50 basis points. Mm-hmm. Well, if it contributed 80 to 90 basis points, incrementally that's only 40 or 50 from the trend that we had seen in other recent expansions. Additionally, you have to remember GDP, going back to introductory macroeconomics at university, GDP is equal to C plus I plus G plus the quantity X minus M. GDP is equal to consumption, the C, plus investment, the I, plus government spending, the G, plus X, exports, minus imports. Net exports are always a drag on GDP because the U.S. is a net importer. We import more than we export, so M is greater than X. When people say CapEx accounted for half the growth in the first half as much as consumption, they're only counting the I, which adds to GDP. But any investment that involves imported components gives with one hand and takes away with the other. Think of these data centers. The servers that are going on racks to perform the AI calculations, they're not made in the United States. Dell may sell them, Oracle may sell them, but they're full of components that come from overseas and therefore are counted as imports. So you can't say, I spent $1,000 on a server, I boosted GDP by $1,000. I would estimate you boosted GDP by maybe $200 because you get 1,000 plus in I, but you also have 800 minus in M. The NVIDIA chips, they're designed by NVIDIA, they ain't made here, they're made by Taiwan Semiconductor. And when you do all that, you find that AI CapEx is a tailwind. It is a tailwind that will persist, I say, for at least the next 4 quarters. But it's a pretty gentle tailwind, and compared to the labor market, given that consumption is 2/3 of activity in the United States, consumption's impact absolutely dwarfs AI CapEx's import properly computed, and consumption hangs on the labor market. So if we continue to see truly anemic job growth, 25, 30,000 a month.
So the Fed is gonna lower the rates.
So the Fed, it definitely means the Fed's more likely to lower rates, and we think it means the Fed is going to cut rates more by the end of 2026 than markets are pricing in. But I would say be careful what you wish for. The Fed will be cutting rates more than expected because the labor market is going to be weaker than expected. That suggests that aggregate demand is going to be considerably weaker than expected because consumption is the lion's share of aggregate demand.
How much possibilities a recession will happen in next 12 months?
I'll say more than 50%, unless we have no humility at all. We know there are no 100% probabilities. We don't have a crystal ball. We don't know what's going to happen in the future. I think it's more than 50%. It is my base case that we'll have a recession. However, if the hiring data improve, if payrolls expand, I'm not going to think that, right? So my base case is that payroll expansion continues to shrink and begins contracting pretty soon. The last 3-month moving average was between 25 and 30,000, right? So it's not that far to contraction. And I don't think even 25 or 30,000 allows consumers to spend enough to keep the expansion going. But remember, we would have gotten the September data 2 weeks ago, right? The first Friday of October. Whenever the shutdown ends, if it ends sometime in the middle of November, then we're going to have September and October data. There's going to be a flood of data all at once. That makes our conclusions turn even more on the upcoming data releases, and I think the Federal Open Market Committee's conclusions turn even more on impending data than they typically would. So we're all going to be more data dependent than normal, and like any good researcher, if the data change, I'll change my mind. Right? And there's more data in the pipeline than there typically is. So I'm not irresolute. I'm not trying to be ambiguous. I think we get a recession. However, if employment growth picks up, then I think consumption growth will not fall into that 1% stall speed level of real consumption growth, and we don't have a recession. It's just that my base case is that we're going to see that continued deterioration and even a speeding up of the deterioration in the labor market. That's going to take consumption with it. That is going to take business investment with it outside of AI for the next 4 quarters, and I think that gives us a recession.
Thank you very much.
Sure thing. Thank you.